Hey, I just want to take a couple of minutes of your time. I know your time is precious, but I want to go through a very important topic that I'm hitting all the time with my clients and buyers as they're coming in. Cost. Looking at the cost of a house. If you're buying, if you're refinancing, or whatever, there's always a cost. And a lot of people think, or mistakenly think, it's just the price. And so I want to go ahead and show you something. There's some math I'm going to go ahead and go through. I do this on the phone with people all the time, and I just think that if we do it here in the video, it'll actually make a lot more sense. So, in the interest of your time, I'm going to go as quickly as I can, but I'm also going to try to make sure that you understand it. And so what I'm going to do is I'm going to compare if somebody buys a house today at $200,000 and they're going to look at maybe I'm going to put it off a year, maybe I'm going to wait till later. I'm going to go ahead and talk about the impact of doing that. And so if they're buying today, first off, I want to address this. $200,000 is not an expensive house in today's market. A lot of people think it is, and so it's important to understand that prices have actually gone up quite a bit. That's not even a first-time home buyer price a lot of the time. So if you're gonna put it off a year, there's a couple things you need to think about. One, the appreciation, the potential increase in price, and then two, the actual interest rates. They also are potentially going up. And so let's look at an example. Sorry, I'm going really fast, but I want to make sure that we get this in a short amount of time. So let's just pretend you're going to go ahead and put 5% down, and if you did that, you're going to have a $190,000 loan, and let's say that you're going to have a 4.25% interest rate in that case. Okay, in this particular situation, your monthly payment is going to be $934 a month. So first off, 5% down. I have lots of zero down programs, lower down payment programs than that. This is just simply an example for math. All right, so it's going to apply no matter what we're comparing. But if you do 5% down, this is an example of how we can actually compare some numbers. So 4.25%, is that a good interest rate? That's kind of a middle rate right now. A lot of people look at that and they're trying to figure out, is that good or bad? So anyway, I'm going to skip over all that stuff and just assume that's kind of a benchmark rate today. That's not your whole monthly payment. That's going to be a principal and interest only payment, just simply a loan repayment, okay? So anyway, let's go ahead and look at what happens if, one, prices go up. So appreciation, right? And then two, interest rates go up. Okay? So what are they supposed to do? Now, I'm not that technologically savvy, but in theory, right about now, there's a video or a little slide that's going to pop up in this video and actually show you if appreciation goes up. So what you're seeing right now on your screen is basically CoreLogic's data. This data has been correlated all across the entire country. And if you focus in on Utah, the top half of that is showing Utah's increase in purchase price from last year to this year, 7.6%. It's a pretty fair amount. It's actually lower than what they were, higher than what they were estimating a year ago. So a year ago, you're looking at this, they were thinking 5-6%, and we ended up coming in at 7.6% more in the purchase price from last year to this year. Not important right now, except for if you go to the lower half of this, it's going to show what they're supposed to do over the next 12 months. Now again, I don't exactly agree with this. They were conservative last year and they were wrong. I think they're conservative again. In fact, to be honest, it would surprise me if we don't break 10% in appreciation this year, just due to the sheer demand of what we got going on. But if you look on this chart, it's showing 4.8% increase here in Utah in the next 12 months. Now, I'm going to put 5%, one, because like I said, I don't exactly agree with them, but two, because it's an easier number to work with. And so if we have a 5% increase in price, that's going to obviously drive price up and drive the cost up. We'll get to that in a second. But interest rates. Interest rate is another piece. Here's some quotes. This will also be popping up on your screen right now, in theory, if I'm that technologically advanced. According to a couple of these experts, Zillow's chief economist says, I wouldn't be surprised if the 30-year fixed mortgage rate hits 4.75 this year. Mark Fleming, the chief economist at First American, I see mortgage interest rates getting much closer to 5% by the end of the year. National Association of Realtors chief economist says 4.5% to 5% this year. I like what he mentions there with the interest rate range. That's actually a more accurate depiction of interest rates. They're never sitting right at that rate. They're highly volatile. They move around, and so a range is more appropriate. But if you take these quotes that are on here, most likely we're going to end up somewhere in the range of about a 4.75 interest rate, which is a half point higher than where we are here. So here's where this matters. Okay, so we had a $200,000 price. We're going to now go, okay, to I'm going to change color here to make it interesting. So 200,000 is now 5% higher. That's $10,000. Is now $210,000, right? And if he's going to put, someone's going to put 5% down. Now they're putting an extra $500 down. Their loan amount is going to be $199,500. And if they have a 4.75 rate, their principal and interest payment is now going to be $1,040 a month, right? Down here it was $934. It's now $1,040 a month. I want to point out this is for the exact same house. Nothing new, and in fact it's a year older than it was, right? So we have the difference between this of $106 a month, and this is where it gets interesting. This is why cost to a house is so important. $106 a month. Hopefully you value that money when you look at this and consider that that's for the exact same house. So you can either pay an extra $100 or not. It's your choice, right? But think about this. That $100 a month, that's $1,200, almost $1,300 a year. Over 5 years, that's $6,500. Over 30 years, it's $38,000. But here's where it's really cool. If I was to actually just stick that, now I'm not a financial planner, so everything I'm about to say is not a qualified statement, and you should talk to your financial planner to verify. But $106 a month stuck into some mutual fund or something where you're earning maybe 7% a year equates to $130,000 after 30 years. So if you're thinking about waiting when you could actually qualify to be buying a house, it's not that big a deal. It's only going to cost you an extra $130,000. Not like you could buy another house with that or something. Anyway, thanks a lot. Josh Thomas at Academy Mortgage. Remember, we're here for you for any purchase needs, any refinance needs, construction, or any investment stuff. So any questions you got, give us a call. We're happy to help you. Have a great day.